Believe it or not, but we're already in the month of June, which means we're close to 50% completion of the year 2024. Yes, I know, crazy how fast this year has gone by. So in this video, let's talk about 4 stocks, 4 companies that maybe, could be, should be on your watch list for this month. Company number 1 is called PAYC Software. Now, we've talked about PAYC at the start of this year. Year to date, the stock is down close to 30%. Year over year, the performance is also horrible. It's down 47%. Why is that? Is the business deteriorating? Is there no growth, no profitability? What's going on? Well, that's exactly what we're going to explore right now. First up, the analyst estimates. It's clear that fiscal year 2024, they do not expect any growth with regards to EPS. EPS basically flat year over year, but then you can see a clear reacceleration in the coming 2 fiscal years with regards to EPS. Sales growth to stay around 10 to 13% or so. And so if we look at the performance of PAYC overall, this is in the last 10 years, but you can focus in the last 3, last 5, but I give you here the big picture. And the big picture shows me that this company is growing revenues steadily each and every year. What else can we see here? Well, we can see that this company is profitable. You can see free cash flow that's in the last 12 months have been growing in the last couple of years, not as fast as before, but still free cash flow positive. That's great. If you look at return on equity, 33.81%, very good. Return on invested capital, 31.8%, can't complain on that either. If you look at gross profit, that has increased year over year for the last couple of years as well. It's now at $1.51 billion in the last 12 months. Net income positive, has also grown in the last couple of years. Yes, it's true, more recently a bit slower than before, still at $468.6 million in the last 12 months. If we currently look at the average analyst price target, it sits at $195, which represents 34.6% upside from the price we're at today. Now, of course, you're seeing a huge dump here in the stock price. We've talked about the cannibalization of their new product called ADBE, basically cannibalizing revenue because it's basically an automated payroll processing system. And like I said, cannibalizing existing products for PAYC, where previously company would have to pay for a service like this. Now they do it themselves. Now you're probably asking yourself, well, does that make any sense, right? Why did they choose to do that? Why cannibalize your own revenue stream? Well, it's true that in the short term, they're taking a hit, but for the long term, it makes sense. For the long term, this is a way to attract maybe other potential customers, and then you start upselling your other product offerings. Of course, like I said, short-term hits, long-term gains. Let's dive a little bit deeper. So for the first quarter, revenue came in at $500 million, that's up 11% year over year. GAAP net income came in at $247 million, representing 49% of total revenues, or $4.37 per diluted share. Non-GAAP net income came in at $147 million, or $2.59 per diluted share. First quarter adjusted EBITDA of $230 million, representing 46% of total revenue. A couple of comments here. Led by Betty, our differentiated product strategy, we continue to deliver value to businesses that leverage HCM automation while simplifying the lives of employees and HR teams across the globe. Throughout 2024, we remain focused on expanding our solution automation capabilities, increasing client ROI achievements, and delivering world-class service across organizations. These pillars are expected to fuel our momentum for years to come. And so if the numbers were quite good for the quarter, which they were, what's the issue? Well, as always, it's always guidance. So Q2 sales and EBITDA estimates fell short, but for the full year, the numbers came in line, if not a little bit better. And so for next quarter, they expect total revenue in the range of $434 million to $438 million, adjusted EBITDA in the range between $151 and $155 million. For the full year, total revenue to come in between $1.86 and $1.885 billion, and adjusted EBITDA between $720 and $730 million. Now, one thing I want to repeat again is this metric here, which you can find in their press release. So funds held by clients. This is the amount of money, $2.72 billion, that they can use and earn interest on until, of course, their clients want that money out. It's quite a lot of money, especially now in a high interest rate environment. And right now, if we look at the graph, the stock is now officially oversold on the weekly. If we look at where it is, $145.3, it's back to the lows that we've seen in October of 2023, end of October 2023. Let's wait and see if this time we can find support again and rebound from that area. So that's company number one. Before jumping into company number two, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So stock number two is a stock that was pretty popular back in the pandemic crazy era, right? The stock was popular. The company itself, not so much because of the lockdowns. Well, the company did not perform well at all. The stock was basically a casino type of stock. It's not a casino stock, but it's a cruise one. It's Carnival Corporation, ticker symbol CCL. You might think I'm crazy. Why are you talking about cruise stocks right now? Well, because I do think that you can find value in plenty of other industries right now. I mean, Abercrombie & Fitch has outperformed Nvidia for a year now by quite a lot. So yeah, there is that. Anyways, Carnival, close to $19 billion in market cap, forward PE 13.9 times. Year to date, the stock is down 18.66%. Year over year, the stock is up 34.2%. In the last 3 years, stock is still down close to 50%. And if we want to zoom out a little bit more, 5-year performance, stock is down close to 70%. Of course, the huge hit came when the pandemic started. But this is where the interesting part starts. So let's first look at the analyst estimates. For fiscal year 2024, they expect sales growth to increase 13.6% and EPS to be $1. Of course, previously that was negative. But then you see huge continued acceleration with regards to EPS, 42.4% year-over-year growth in fiscal year 2025, followed by another over 20% year-over-year growth in fiscal year 2026. Whereas sales growth is decreasing, 5.6% in fiscal year 25 and just 2.34% year-over-year growth in fiscal year 2026. So this again becomes a story of becoming more and more profitable or getting back to the profitability levels of pre-pandemic. Because if we look at the business performance, these are last 12 months metrics, but you can see that in the last 10 years, of course, you had that horrible couple of years here because of the pandemic, but now we are seeing quite a solid rebound, sales growth, and also back to profitability levels. I mean, sales growth in the last 12 months, revenue is already higher than just before the pandemic. Plus, you're getting back to free cash flow positive area, which is fine. Return on equity sits at 6.3%. Return on invested capital sits at 6.16%. And you can clearly see here the big rebound. Same with net income and gross profit. Of course, first you saw gross profit turn back into positive, and now we're seeing net income turning positive as well. If we look at the average analyst price target, still sits above $20 at $21.22, representing 40.7% upside from the price we're at today. And so if we look at their recent performance, net yields versus 2023, guidance was approximately 16.5%, came in at 17.2%. Adjusted EBITDA was expected to be around $800 million, came in at $871 million. Adjusted net income, which was a loss, guidance was a loss of $280 million, came in at a loss of $180 million. Same story here with adjusted earnings per share, came in better. All of that is driven by continued strength in demand, pushing ticket prices higher. Of course, if there is an economic downturn, then yes, these are the types of companies that will definitely feel it. But don't forget that people reserve their cruises far in advance. And also if we look at the yields right now, the improvements as well, and this metric right here, net per day or net per diem, not sliding into my DM, but I don't know how you will pronounce this, but basically this is net revenue per passenger cruise day. All of those have increased year over year, which led the company to have an improved full year guidance when it comes to net yield, adjusted EBITDA, adjusted net income, and adjusted earnings per share as well. All of those have improved, and that's up nicely. Now it's true that Carnival has a lot of debt, but since the company is now getting more and more profitable, and right now they already have, well, they should have 3 ships delivered in fiscal 2024 and only 2 until fiscal 2027. Since the company is becoming more and more profitable, they can use those cash flows to repay the debt. And that's also possible since CapEx remains the same and the company's profitability levels keep improving. Let's have a look at the stock for a second. So right now, with regards to RSI, it's still pretty neutral. If you look at where the stock is, it's basically at the 200-day moving average, at the 21 as well, and just under the 50-day moving average. So if it can hold those areas, I think it could be a good bet, let's say, for the short term, because long term, I still think this company will do quite well, but short term, we don't know what the market will do. Still quite sensitive when it comes to interest rates. And of course, a company like Carnival, like I said, if there is an economic downturn, this is a business that will take a hit. Whether or not the business really takes a hit, the stock will, because sentiment will change a little bit. But stock-wise, it has been making higher lows all the way back since October 2022. It's true that we had a double top here, one top in July of 2023 and the second one in December of 2023, and then the stock took a little hit. But so far, I think there still is some positive momentum with cruise stocks. I understand that we talk a lot about tech stocks on this channel, but I do really think that there is a lot of opportunities outside of tech as well. Now, saying that, we have to switch back to a tech company that, in my opinion, is a very, very good company, a solid compounder. Yes, it has taken a short-term hit right now. Yes, it will report earnings, I believe, in 10 days' time or so. So as always, as we've discussed with Zscaler and Ulta, you can either bet before the earnings or wait until the results and maybe risk the stock going up 15%, but at least you're seeing some more numbers. So do with that what you want, but the company is obviously called here Adobe. Adobe year to date is down 25%. Over the last 5 years, it has performed quite well. It's up 62%. Now, Adobe, just like plenty of other software stocks, got hurt during the week because of Salesforce, because of the fears that AI might destroy software companies. I'll talk a bit more about the software thing later today in the portfolio video. But right now, what do analysts expect for this company? Basically, a bit of the same each and every fiscal year. Sales growth, low double digits, EPS growth between 12 to 15% year over year until fiscal year 2026. If we look at the business performance throughout the years, revenue has grown steadily, free cash flow has grown steadily as well, although we can see that it has peaked more recently. But all the rest, still an amazing company, an amazing profitable company as well. Gross profit has grown very, very well in the last couple of years. Net income as well. And just like free cash flow, it has peaked more recently. But right now, if you look at forward PE, EV to EBITDA, price to sales, price to free cash flow, it's all lower than its 5-year mean. Price earnings to growth sits at 1.41. Again, I still think this is one of the better companies out there that will benefit from AI, unlike some of the criticism that we're hearing right now in the markets. I think AI is not going to destroy a company like Adobe. And I think most of the analysts agree with that statement, because right now the average analyst price target sits at $614, representing 38% upside from the price we're at today. Of course, you don't have to base your thesis on an analyst price target. Taking a look at their Q1 earnings, revenue was $5.18 billion, increasing 11% year over year. GAAP earnings per share $1.36, that's down 50% year over year, but they did take a hit with regards to the Figma acquisition or the termination of that acquisition. That's about $1 billion, so that's a big hit. Non-GAAP EPS $4.48, that's up 18% year over year. More specifically, for the quarter, digital media revenue was $3.82 billion, net new digital media ARR of $432 million, digital experiences revenue $1.29 billion, cash flow from operation $1.17 billion, RPO of $17.58 billion exiting the quarter. That's an amazing number. I believe it was a record. And then they also repurchased approximately 3.1 million shares of their own stock. They also announced a new $25 billion share repurchase program. But the problem, let's say, was that one, full year guidance remained the same as the one that they gave back in December, which, by the way, in December that was well received, but last quarter, not so much. So yeah, quite funny. Second of all, with regards to the Figma termination payments, so that will have a GAAP EPS impact, of course. It rolls through Q1 and will certainly have a negative effect for the full year. So the quarter that they're going to report pretty soon, revenue should come in between $5.25 and $5.3 billion. Digital media net new ARR around $440 million. Digital media segment revenue around $3.9 billion. Digital experience segment revenue around $1.32 billion. And lastly, digital experience subscription revenue around $1.17 billion. And of course, we will be looking at the impact of the AI credits, how they are going to monetize that in the future. Are they already seeing some positive effects with that? If you don't know what the AI credits are, it's basically if you use one of their generative AI applications, you use credits to use those. If you use all of them, you obviously have to pay to get more credits. So let's see how they monetize all of that. And so right now, if we look at this stock, this is a higher lows pattern that started back in October of 2022. Right now, we did finish actually the week above that. So that's great. Let's wait and see until the next earnings report whether or not we break under that or if we see a solid rebound. The 200-day moving average sits at $518, the 50-day one at $495, and the 20-day one at $481. Like I said, I'm pretty bullish on Adobe. I think they have the distribution, right? You can have a lot of new applications here and there coming out. But if you don't have the distribution, then who's going to use it? Adobe has the distribution, Adobe has the partnerships, they're working with all the big players, the integration in Photoshop, in After Effects, you name it. I think Adobe will be a long-term winner, growing steadily, profitable, buying back shares, returning value to shareholders as well. I think it's one of the better companies out there. And so to end this video, we have to talk about the last company. It's going to be a pretty quick one because we've been talking about this company for quite a while, and that's PayPal. PayPal is basically flat year to date, up 2.57%. Over the last 5 years, the stock has done horribly. It's down 43%. But the business itself has grown. And if we look at right now what the analysts are expecting, EPS to take a huge hit in fiscal year 2024, down 19.15%, and sales growth to grow for the next coming fiscal years, high single digits, but then we can see a small reacceleration in growth with regards to EPS. Now, if we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, it's all much lower than its 5-year mean. Of course, you also have to take into consideration the high multiples that it got, basically because of the pandemic, because of the high growth. But even without that, the company, in my opinion, is still extremely undervalued. We've talked about that on the channel for quite a while. We've brought in the bear case, we've brought in the bull case as well. We even brought the case where it doesn't grow at all, which is exactly what it's priced at right now. Zero growth, which is not true since it is growing. And of course, right now, since the stock is extremely depressed, in my opinion, since the company is still generating quite a lot of free cash flow each and every year, they can buy back a lot of shares. I mean, in the last 2 years or so, they retired close to 11% of shares outstanding. And for this year, I think we're going to retire at least $5 billion worth of stock. So the longer it stays at these prices, the more shares they can buy back. Now, looking at the average analyst price target sits at $77.69, representing 23.3% upside from the price we're at today. I think we've got around 2 to 3 analysts that turned a bit more bullish on the company, so maybe slowly but surely sentiment is changing. And if we're looking at the stock right now, still below the 20, the 50, and the 200-day moving average, not by much. The 200-day one sits at $63.88, the 50-day one at $63.76, and the 20-day one at $63.70. So we're pretty close to that, and RSI is still neutral. Now, I know already what plenty of people will say. Again, PayPal is a bad stock. Stocks should be worth much less. The competition is eating their business. Nobody's using PayPal, etc., etc. Okay, maybe you're not that patient. Maybe this is not a stock for you. Plus, if you look at this picture right now on your screen, it's true that take rate has come down as there are more and more players coming in. But then how come free cash flow has increased throughout the years? Yes, it's true that right now free cash flow has been decreasing a little bit. But again, you have to take into consideration the huge increase that the business got throughout the pandemic. Plus, we believe, and management alluded so, that the company will be growing in a profitable way. So I think that free cash flow in the coming years should be higher than what it is today. So again, more competition, but generating more free cash flow. So your bearish point here again makes no sense. It doesn't hold up. Again, I know short-term pain is not for everyone, but those that are staying with PayPal, those that do have long-term investment horizons, I think will be rewarded quite handsomely. So overall, that's about it. Those are the 4 companies. I know it's probably a long video, but at least you got a lot of information. Timestamps will be down below. Share your thoughts, like and comment, subscribe, do all of that, and I'll see you all in the next one. Bye bye.